Good morning, everyone. This is
Morning,
Kathy.
Kath.
This is Kathy Tarochione, Ron Surz, and Steve Zuschin, right? That's Polish. Zuschin.
Zuschin.
Okay, Zuschin. Welcome, Steve. You are from LifeYield, and today we're going to be talking about maximizing your retirement income. Do you want to introduce him, Ron?
A little bit. I want to introduce this is our 12th show, and most of the shows have been about investing. It's the Baby Boomer Investing Show. But we have had guests in the past. We had a guest about Medicare. We had a guest help us talk about reverse mortgages. And today, Steve is going to help us maximize our spending so we can be off the investing topic and coming to what it's all about. We save and invest in everything because we're going to spend it. So I'll turn it over to Steve, and he's got some, I think, really important advice for us and how we can make our savings last. Thanks, Steve.
Yeah, thanks a lot, Ron. I appreciate you all having me. And, as you mentioned, I'm a guest of LifeYield, which is the company I work for. And a little bit of background on LifeYield is we are a technology company that focuses on building software to help people make better decisions and get more or keep more of all of the money that we work on saving so hard so that we can have a good retirement. And one of the concepts that we've developed, we call smart householding. And smart householding is really about thinking about our retirement from when we start saving all the way through to when we get to that point where we're going to retire, how and when to file for Social Security to maximize our retirement income alongside all the other assets that we've saved. And then really, how do we take all these investments and the savings that we have, and how do we spend that in the most accurate way, and how do we draw it down to be as tax efficient as possible? So that's really the introduction of the topic that we're going to focus on today.
Okay. Yeah.
It's important.
Yeah. Okay. So are we ready for the slides, Steve?
Sure. Let's jump in.
Okay. Let's go. And this is you.
This is me. So again, my name's Steve Zuschin. I've been focused in this area for majority of my career, really. I started out as a financial advisor with a large financial services company. And I really got attracted to how technology was really reshaping financial services. And, one of the big concepts, especially when I joined the industry, is financial services was very focused on selling products. And so anybody who's been around for longer than 20 years has been sold a life insurance policy or an annuity or a mutual fund, or maybe they had a few meetings with a stockbroker that was giving them stock tips. And the industry, financial services as a whole, has really started to grow and expand to more of an advice-based business. And what that entails is that rather than selling individual products, we need to think about it more holistically. A lot of our behavior is going to fall into that. And so I got involved in what we call wealth technology, where we're building technology really where we're catering to financial advisors and helping them give better advice to improve investors' outcomes. And
That is fascinating. And so much, what timing you guys have, really, especially now, because everybody is going to remote and they need that technology in order to actually conduct their businesses these days. That's for sure.
Oh, even as we all know, in the last couple of months, we've been given some hurdles that no one really anticipated with having technology and how to conduct business remote, since we're not able to necessarily sit in the same room or meet up in the traditional sense. But, long before COVID, technology started playing an instrumental role. I mean, the way that life has evolved and the complexities of all areas of life, not just finances, the problems have really gotten too complex for an individual to solve on their own without the assistance of technology.
Sure.
And, one of the things that we like to talk about is, with people, as we talk about retirement, if we just go through the path of someone that's getting to the point in retirement, well, leading up to that, we've had career changes, we've had families, we have had children, we've had grandchildren, career changes, and all of these things generally add up to a very complicated situation as it relates to your finances. So as you're going through and switching from different careers, you're accumulating multiple savings accounts as well. So you end up with what we've found is that the average person, the average American, by the time they get to retirement, has over 9 accounts, 9 investment accounts. And, the advice that's been given contributing to those investment accounts is usually spread across multiple financial professionals, whether that's someone at a bank or an advisor that you worked with at one point or another, an insurance agent. And what that all adds up to is generally, for the topic that I'm going to discuss, taxes, it creates inefficiencies.
Mm-hmm.
And so the concept that I'm introducing here with this key industry trend is smart householding, where we really need to take a focus where we aggregate all of those accounts and have one common goal. And by coordinating all of these accounts that people kind of rack up and put in their backpack and keep moving forward and think about the decisions that they're making as they move forward, we need to remember the things that we have already worked on and make sure that everything is working together. And so I'm sure most people are at least somewhat familiar with what an asset allocation is. And that is just the makeup of all the different investments that we buy and what percentage of those investments are invested in equities versus bonds, or how much cash we're holding. But there's another concept that is called asset location. And so all the different accounts that I've kind of mentioned here, where we have IRAs, individual retirement accounts, 401ks, 403bs, all of these different types of accounts, generally those just refer to a piece of tax code. And so those are what we would call qualified accounts. And the reason why they're qualified is because the IRS has said, hey, we'll make a deal with you, and we're going to allow you to save money, and there's going to be some sort of tax benefit to using these accounts. But we're going to get ours, and maybe that's going to be later, or maybe there's a benefit to you now, but each one of those different accounts has a tax benefit or a consequence to saving money in them. And then there's another type of an account, which we would call a non-qualified account. And generally that's just a taxable brokerage account. If you go to any discount brokerage, or if you go to Schwab or TD and open an account, it'll ask you if you want to open a retirement account or a brokerage account. And what ends up happening is people accumulate these different accounts, and they go throughout their career investing and buying different investment products. And each one of those accounts has these different benefits around taxes. And whatever investment you buy in those accounts, there's going to be a tax consequence to that, whether it's when you sell those investments in your retirement to turn it back into cash, or maybe right now, or maybe on an ongoing basis. If those investments are paying dividends or yield, there could be a tax consequence on an annual basis to that income that you receive. And so what asset location does is it optimizes all the investments that you should own based on your target allocation across the accounts to be as efficient as possible. And what that allows you to do is keep more of your investment savings.
Yeah, and doesn't that make sense too? Because think about it, this show is about boomers, baby boomers, and we don't want to have things all complicated and messed up. We want them all organized so that we can just wash our hands and not have to do anything.
Right.
So it becomes easier the more that we have some things that are done for us and controlled for us.
Absolutely. And, the trends across the industry, and, I know that the show, and we're talking about baby boomers, but even if you go to a millennial, or some of the younger generations that are coming now, they want simplicity too.
Mm-hmm.
And I think that it aims at everybody, that we've seen that there's a way to offer simplicity and a way of solving very complex problems in a simple way where we can retain and see the value in that process. That's extremely important. So at LifeYield, what we've actually created, which I'll talk about a little bit more later, is we've created a score. We call it the tax efficient score. And behind the scenes, there's a pretty complex algorithm that's looking across all the investments and all the different accounts. And we just score the portfolio on a scale of 0 to 100. And the closer you are to 100, the more efficient your portfolio is operating.
Great.
And as part of the software that we offer to financial advisors, we show them how to improve that score. And a lot of the time that means that they have to work with their clients, and the client has to be on board to make decisions and make changes that'll also improve the score. But it's a way of simplifying the value and really showing you that there's a lot of value in the decisions that you're making, rather than just kind of, I don't understand it, but if you say so, I trust you.
So Steve, as a general rule, would you segregate the investments that would be very taxable and put those into qualified plans, and then those that would tend to pay lower taxes like municipal bonds, things like that, into the non-qualified plans? Is that sort of the general idea of getting tax efficient?
Yeah, I mean, a real general rule of thumb would be exactly that, Ron. So taking the less or the least tax efficient assets that you have, and maybe the ones that are going to grow at the highest rate, and put those in your Roth, and the other stuff in your IRAs, and then the more tax efficient assets in your non-qualified or your brokerage account.
Got it. Just out of curiosity, where would hedge funds go? Can they be held in a qualified plan?
It depends on the fund. So each hedge fund's going to operate a little bit differently. But yeah, generally alternatives are going to be good inside qualified accounts if you can get them there. Sometimes you can't do that because of the holding period of the product, or any type of alternative that they might not be as liquid as you'd want. One thing to keep in mind is that qualified accounts like IRAs and 401ks, they also have these things called required minimum distributions.
Yes.
Once you reach a certain age, the government says, hey, we've given you this benefit and we've allowed you to defer this growth and not pay taxes. But hey, you're at the age now, you have to start cashing in these investments and giving us some of our money back.
Got it.
And that's the deal you make. That's the deal you make with our government.
Mm-hmm.
Good morning, Dale. Thanks for watching.
Hi, Dale.
Okay, so we want to go with the...
Yeah, another big contributor is Social Security. So when we think about our overall retirement income, regardless of where you are on the spectrum of how much you've saved, what your net worth is, for a lot of people, we're entering retirement with a lot of challenges. We've had challenges throughout life, and we may have not been able to save every penny that we've wanted to have that perfect financial plan. Social Security can play a huge role in the overall success of our retirement. And so there are some filing strategies. Now, I know a lot of people, the common word on the street is that some of the strategies to maximize your Social Security, like file and suspend, are going away. So those strategies they're aging out. So the government has made changes that if you're over a certain age, and I don't know the specific age right now, you're not able to file and suspend, but there still are strategies to maximize the amount that you get from Social Security. And so today we're also going to talk a little bit about how that plays out in the overall theme of smart householding, and how to make better decisions about when and how to file your Social Security to contribute so that you have the best retirement available to you.
Okay, that's what I'm interested in.
Yeah, one of our shows, we pretty much showed that 55 million baby boomers are going to rely heavily on Social Security. So it's a lot of people.
Yes. Yeah, definitely.
Absolutely. Now, I've mentioned taxes quite a bit here, and I think that, for baby boomers who are approaching retirement right now, it's going to be very important on how they spend their money in order to be as tax efficient as possible. But this theme of asset location, it's really the idea of compounding interest. The longer time you have, the longer that time horizon is, the more amazing it becomes. And so the whole idea of asset location is the sooner you can fix it and improve your tax efficient score, the more valuable it becomes. And that just compounds over decades, right? But it's been proven time and time again that taxes, not market volatility that we've been seeing recently or throughout our careers, or the fees that are so commonly in the headlines that you get charged for, whether it's an investment product or the advice that you're getting, the taxes can be the number one drag. And so anything that you can do to reduce unnecessary taxes, we're not talking about any strategy to avoid paying taxes entirely. We're just saying that you shouldn't pay more than your fair share. And so if you can adopt a strategy like asset location earlier on, you're able to reduce or kind of stop a leaky bucket of unnecessary taxes, which just allows those investments to stay invested and grow longer and become more for retirement.
Okay, so what you're saying is that people are really paying too much tax.
Yeah, I mean, too much is, relative. It's
Okay.
a matter of, I mean, some people would say that $1 is too much, right?
Oh, okay.
So let's just think of it as your fair share. And
All
so,
right.
previously these types of strategies, when we didn't have the power of like the internet or these algorithms like LifeYield's developing, it was too complicated for somebody who didn't have millions of dollars
Right.
to be able to, you couldn't afford to go hire a CPA firm that would be able to focus. And, if they're saving you $100,000, you might pay $150,000 to the CPA firm to figure out how to do that.
Yeah.
The really wealthy people, have hired people to save them a lot of taxes, and anyway.
And it's worth it to
trade-off
pay
is
somebody
obvious.
to do that. Yeah.
You could pay a lot of money if you're making a lot of money because it nets out. So
Yeah.
Exactly. I mean, and that's exactly true. And that's kind of one of the awesome things about technology and being able to scale this. I like to look at it as it's democratizing this knowledge. It's making some of these.
That's a good idea.
Yeah.
It takes some of these really complex situations or solutions and brings them down to people who, they just normally wouldn't have that available to them.
Right.
Sure.
Yeah. Yeah. Because you always wonder how come, why did the politicians and all the rich people pay zero taxes and we get stuck with higher taxes? So
Yeah.
Okay. I'm enjoying this. Okay.
Yeah, exactly. So we actually prepared a video, if you don't mind playing that explains smart householding. And we can talk a little bit more after you play that.
Okay.
Householding is about getting a complete view of all your accounts and holdings. But what's a view without action? Smart householding takes this view a step further by coordinating all these accounts so they work together to minimize your investment taxes and maximize your after-tax rate of return. This is done through a technique called asset location optimization. By taking all the assets within your household and distributing them to the correct accounts, you'll avoid paying unnecessary investment taxes. While so many investors have tried to beat the markets in their quest to achieve investment goals, they've learned the hard way that this approach doesn't work. Aggregating and coordinating accounts can reduce costs, manage risk consistent with your comfort level, and increase your portfolio's overall tax efficiency. This approach has helped investors save as much as 33% on taxes over time, according to a study by Ernst & Young. Investment taxes are complicated to explain, so we use tools that benchmark the overall tax efficiency of a portfolio and show you the steps being taken to decrease your investment taxes and increase your after-tax rate of return. After all, it's not about how much money you make, it's about how much you get to keep.
All right. I think that sums it up, right?
Uh-huh.
Good handwriting.
Who
What?
wouldn't want to get an extra 33%, right?
Yeah.
And that's kind of the foundation of what LifeYield started. Our founders had a passion for trying to improve retirement income for investors. And we found that the easiest way to implement this software is by servicing financial advisors who work with those clients. But even for those that aren't working with financial advisors, there are some steps that people can take to try and reduce the amount of tax liabilities or the amount of unnecessary taxes they're going to pay leading up to retirement. And so one great way to start is using an online, what they call an account aggregator. So I'm sure most of us have heard of tools like mint.com. A lot of banks like Chase, they have tools that you can use on their websites for free that just allow you to link up all your accounts and get one picture of everything in one place. And this doesn't require advice from a financial advisor. Most financial advisors will also have access to tools like this that not only help you get a view of everything that you have from your checking account to your credit cards and your mortgage, but even for your own right, just being able to see everything in one place and get a clear understanding of what your balance sheet looks like, and also get an idea of what investments you have in different accounts. Most banks are also going to be able to offer you some advice on whether or not an asset is going to be tax efficient, or whether or not you might benefit from what Ron mentioned, maybe investing in municipal bonds rather than taxable bonds. Now that can be a personal decision based on the investor's profile and what their tax rate is and what state that they live in, and how valuable that decision can be. But just some real simple things like that can really start to make a big impact on how efficient your assets will be moving forward. And as we stated in the video here, it's not about how much you make. And there's such a big focus on how markets are performing and what investment you're going to choose and what the rate of return on that investment is. But, if you're going to get a 9% rate of return, but your actual take home or your after-tax rate of return is down around 6%, what if you could actually bring that up a little bit? So the 6% is what we tend to focus on and where we try and offer the improvement.
Okay, very nice. I love the video scribe type of videos too. Whiteboarding, yeah.
The whiteboard videos. I mean, we again, I think it's about creating simplicity, and I don't know you guys, but even for myself, if I don't see value in an action, if I can't clearly understand how this is going to impact me and add value, I'm a lot less likely to follow through with whatever I need to do on my end.
Sure.
Yeah, exactly. Talk is cheap, that's for sure. You got to put it into action. Yeah, right. Yeah, put it into action.
You're
right,
action.
Steve.
So we, at LifeYield, we tend to always focus on how can we simplify this message and really clarify the value. And we feel that the tax efficient score has done a great job in helping advisors. A lot of advisors focus on these strategies, but they have a very hard time communicating the value to their clients. And once they're able to communicate that, it really drives the client to say, hey, I want to improve my tax efficient score, right? It kind of gets that gamification or the motivation for us to, hey, what can I do to improve the score? And that's some of the best feedback we've gotten about our software is that clients get engaged in improving their own outcomes. And, it's a two-way street. So at any time in financial services, if you just rely on somebody and you outsource it 100%, you have a lot less control. The value of that service goes down quite a bit.
Sure. And it'd be foolish not to do it. You're just rearranging assets. So you have pretty much, I think, the same assets. You might make a few changes, but just by putting things in different places, you can save a lot of money.
Exactly. And Ron, that's the thing that I really love about it is that it's not about some secret investment product that wasn't previously available. It's owning exactly what you own today.
Exactly.
Just making sure it's in the correct place to really improve that after-tax rate of return.
Yeah, that's valuable.
Super valuable.
Yeah.
So moving on, I already mentioned this at the beginning, but another huge component for most of us, and as you already said, over 50 million baby boomers are going to retire or are going to rely on Social Security in retirement.
Yes.
We found that to be a huge dilemma. There is a lot of water cooler talk around how to file for Social Security and how much you'll get. And there's so much misunderstanding. And, you hear people on both sides, but for the most part, a lot of people are very uninformed about how Social Security works and the fear. They let a lot of fear and the rumor mill influence the strategy that they choose. There's a lot of fear that leads to people filing early. There's misunderstanding about what your full retirement age is. So having a clear understanding of what your full retirement age is, having an estimate of what they call your PIA or your full retirement age benefit. So when you get a Social Security statement in the mail, there's going to be some numbers on there and it'll tell you about how much you can expect to receive from Social Security. Now, if you're still working and you're still earning income, the math that's adding up to how much you'll receive from Social Security is going to be constantly changing. So when you talk about making an estimate about your Social Security income and how much you'll receive, it's kind of a moving target, right? So depending on how much you're continuing to earn before you file, it's taking the most recent or your highest earning years, and it's creating an average. And so if you're beyond that and you're continuing to earn and maybe earning more than some lower points, it's going to knock those lower years off and it's going to raise your average. If you're still working and you're earning less and less, it might not even be contributing to it. So it's just important to know that when you're making these estimates, it's important to have your most recent up-to-date Social Security statement. You can get them. You can go create an account on Social Security or SSA.gov. Log in, put in a couple of information. It just takes a couple of minutes, and you can download your most recent document, your Social Security statement, and see what those numbers are. But I had mentioned earlier that some strategies are starting to time out, but there are still some really good strategies that can enhance your Social Security income and what you receive from Social Security. And when you have a couple and you have a two different Social Security incomes, there are strategies that you can employ depending on when each individual files that can make a substantial difference. I mean, we're talking $100,000, $150,000, $250,000 over your lifetime, which for a lot of us that are going to rely on Social Security, why wouldn't we want to make sure that we're going to be able to get as much as we can from the Social Security Administration?
Sure.
Mm-hmm. Yeah.
So what do you say to people who say, I think Social Security is going away, so I'm going to apply early? I have an opinion, but what is yours?
It's everybody has their own opinion about this. But what I will say is that our Social Security system and being in America, one of the things that separates us from several of the other countries in the world as a first world country, taking care of the older people, the older members of our community, and taking care of the retirees and allowing people to have that safety net is one of the things that sets us apart. So the idea that Social Security would just go away and the government would allow the trust to be depleted and we're going to leave everybody high and dry is, I think, extremely far-fetched. Also, the Social Security Administration running out of money, this isn't a new fear. It's not a new topic of conversation. Sure. This has been a challenge that the Social Security Administration has faced ever since they first started distributing Social Security numbers.
Yeah, that's true. Yeah.
Yeah. But I'll only say this, it's real. There's a real problem down the road. And my personal opinion is they won't cut off people currently receiving benefits, but something's got to give.
Mm-hmm.
Something does have to give. I would agree. And, but what I would say is, as we've seen recently, I mean, starting, over the last decade plus since the financial crisis in 2008 and 9, is we've seen the federal government step in and come up with creative ways, whether we agree with them or not, whether or not it helps our balance sheet as a country, the deficit. We saw quantitative easing as a way to, protect our economy. We're seeing a stimulus package as a result of the COVID-19 pandemic, which is helping float our economy and keep people from being completely broke and unemployed. And so I imagine that our federal government and the state governments would work together if Social Security got into dire straits, that we would come up with a creative way to fix the problem and continue offering these benefits to, the older members of our community and the people who have worked so hard to get to that point.
We're going to go a little extreme here, but I'm just going to throw this out.
Sure.
The thing that's driving the trillions of dollars that are in quantitative easing is called modern monetary theory. And there are some economists who have been promoting that, encouraging it, but there are a whole bunch of really smart economists who say it's going to blow things up. It's going to be terrible. You're throwing trillions of dollars in multiples of GDP into the problem.
Wow.
So, and to just rely on that and say the government's going to bail us out, it's an experiment. I hope the modern monetary theorists are right, but believe me, there are so many really smart guys who are going, this is going to end badly.
Yeah.
So, anyway.
And time will tell. But as far as Social Security goes today,
for now we're good.
We're safe. You and I are safe.
We're going to be in pretty good shape, and I'd say probably for the decades to come, we're probably in pretty good shape.
I think you're right. So it's like the optimist falling out of the skyscraper. Everybody heard him saying, "So far, so good."
Yeah, yeah, right. Yeah,
and reasonably good chance that we won't live long enough to get hurt by this. So it's.
Yeah. I was going to say, Ron, both you and I can say, well, not in our lifetime.
Yeah, that's right. Somebody else's problem.
Yeah, exactly. Okay.
Well, we prepared another quick video if you want to play that, Kathy.
Okay.
Describing the benefits of Social Security.
Okay.
There's a lot of misinformation out there about Social Security. People receive information from a variety of different sources and often don't know which information applies to their specific scenario. That's why it's critical to use a Social Security optimizer to help you maximize your retirement benefits. It should take into account all applicable Social Security laws, you and your spouse or ex-spouse's birthdays, and life expectancies. To optimize your custom filing strategy, consider 3 key variables. First, consider your primary insurance amount, also called your PIA. This is calculated from your top 35 years of working at a job that paid into Social Security. Second, consider any non-covered pension amount from working at a job that did not pay into Social Security. Having a non-covered pension amount will reduce the amount of retirement benefits that you receive from the Social Security Administration. And third, consider delayed retirement credits, also called DRCs. Postponing collection of benefits can earn you an additional 8% in DRCs every year that you delay filing until age 70. When choosing a filing strategy, we'll work with you to help bridge the gap in income that may result from a delay in filing. It's not only about when and how to file, it's about all the layers of your retirement income working together to get you a tax-smart retirement paycheck.
Yeah, it's complicated.
Yeah.
It is.
A lot of things to consider.
Yeah, I mean, we
Okay.
like to think that we like to think that it's just this simple thing. But the one thing I would mention to the audience today is just to err on the side of caution. When you go to your Social Security department and you have an appointment to file, the people there are not there to help you maximize your benefits. They're not there to help you evaluate between 2 different strategies. They're there to help you make sure that you signed the correct documents and that you check the right boxes and to get paid. Really depending on however you filled out that application. So they're not there to help you maximize those benefits or even understand your options. And so it's important that you all have access to different calculators on the internet or optimizers like LifeYield offers that can help you put in a few variables like your income history, your age. Now, one of the big contributors around when and how you're going to file, this one variable that we have is when is our life going to end? And so most of us tend to not know when that's going to happen. So to your point,
You
Ron,
think?
there is the argument that I'm going to file as soon as possible and get what I can because the Social Security Administration might not be there for that much longer. But there's the other argument that I'm going to file as soon as possible and get what I can because I might not be there
Sure.
to enjoy it if I wait. That is a valid concern and it should be part of what ways, but we also need to be realistic about it. You know, if your family demographics and the history of the health of the other members of your family, if people live for a long time, generally past 80 years old, you're probably going to benefit from delaying and getting that 8% increase.
Makes sense. So, Steve, you mentioned LifeYield twice now. I don't know who they are. What do they do? And should our listeners be visiting their website? Are they better or worse than LifeYield? Or
by all means, visit our website, lifeyield.com. Now, we are a technology company. We develop software for the financial services industry. Now, we tend to cater to banks or large institutions as well as independent financial advisors.
Oh, I see now. I was hearing a different word. I was hearing Whitefield. You were saying LifeYield.
LifeYield.
There's nothing wrong with these earphones.
No, Ron, it's called
LifeYield.
old. It's called old age.
Yeah,
It's a hearing problem. Say what?
It was a good opportunity to tell about your website.
You know, Ron, I don't know if you've ever done sales or anything, but any entrepreneurs out there that are thinking about starting a company or a podcast or anything, look in the mirror, call everybody you know, and repeat that name of whatever you're thinking about naming your company over and over and over again and see if they hear it.
Yeah, that would be a good exercise.
Yeah. Yeah.
I think I call mine Sex and Sports.
There you go.
I don't think anybody's going to mistake that.
There you go.
Well, I get the sports part.
Oh, okay. Anyway, sorry, so we interrupted, but one thing we wanted you to talk about before we get off of Social Security is the do-overs. So you had
Oh, yeah.
Yeah. So
Can I have a do-over?
for each individual, and it's important that you seek out advice. And there's a lot of independent financial advisors and advisors around. If you just look them up on the internet around, that are willing to help you answer some of these questions. In some cases, if you've filed and it's within a certain period of time, if you've uncovered that maybe you made a mistake and you want to wait, they will allow you to actually give back the money that you've already received and do a do-over and wait to file later. We recently just worked with one of our advisors that uses our software, and one of their clients who went and filed for Social Security and then found out that they might be eligible to get survivor benefits off of a spouse of theirs that had passed away. They were unaware of that as an availability, and the Social Security Administration didn't raise it as an option. And when they went back to ask about it, they said, the Social Security Administration said, sorry, you already filed, you're out of luck. Well, with our help and with the help of their advisor, that woman was able to go back, rescind, give back the money, take some of the other assets that she had saved for her retirement and is going to live off of those while she waits to file. But as a result of following this strategy, she was able to uncover an additional $150,000 of income over the course of her retirement.
Oh, that's good.
It was a considerable amount of money, and definitely worth. And she was still getting some Social Security, just not as much as if she filed on her own benefit. She was able to collect that survivor benefit.
Now, is there a time limit for the do-over?
I'm not sure of the specific time limit. I believe it's within a year, but you'll want to check with a professional before you
okay
on that. Yep.
Okay. So we ready to go back to the
presentation?
Okay.
So, we prepared a little case study of John and Pat. This is an example that an advisor shared with us over one of their clients. In this specific case, John and Pat were 10 years away from retirement, so they still had some time where they were going to be saving money and allowing their assets to accumulate. Like I explained earlier, John had multiple jobs throughout his career and continued contributing to 401ks and the different plans that were available to him. But between him and Pat, they never really took the time to coordinate all those accounts. Another thing to kind of point out is that as they excelled through their careers and grew older and life happened, they sought advice that was available to them at the time. And like most of us who have gone through a little bit of life now, when you're 22 years old or 23 years old and just getting out of college and starting your career, there's no investment advisors that are pounding on your door offering to help you avoid making bad mistakes. There's no one doing that. They wait until you've accumulated enough assets to where you're a valuable relationship where they can earn a living off of helping you. And so what ends up happening is, like with John and Pat, they accumulated all these accounts. They sought advice that was available to them at the time. And it wasn't until 10 years from retirement that they were in a position to meet with a financial advisor to help them coordinate everything. And so, like I mentioned earlier, I think the sooner we get a handle on this and start taking ownership of our own retirement and trying to avoid these unnecessary taxes, the better off we're going to be for the long term. When John and Pat met with this advisor, they had both planned on filing for Social Security at age 66, which they believed was their full retirement age. Turns out for them it was 67. And so there is some different people who are walking on the planet right now who have different full retirement ages. So it's important that we look into that and know based on our birthday what our full retirement age is, because it changes. In fact, the government's talking about changing it again right now. So they're talking about extending that out from 67. So people like my age, it might be 68 by the time that I retire. So when I get that Social Security statement, it might say something like, at my full retirement age, I can expect to get a certain amount. Well, if I believe that it's 66 and I go and file, I'm going to get less money, and I'm locking in less money for the rest of my life. So it's important to be knowledgeable about this stuff.
Yeah.
So the other thing on the right-hand side of this slide that we wanted to point out is that when John and Pat started working with their advisor and he loaded all their accounts into our software, they identified that their current tax efficient score was a 54. So about half as tax efficient as we saw that it could be if they had optimized it. And the after-tax rate of return, the expected after-tax rate of return based on the investments that they had purchased was about 7.14%. So if we go to the next slide here, how they solved that problem was they consolidated all their accounts with one financial advisor. Now, I know from even my own experience, I've gone through several once-in-a-lifetime economic challenges. So I grew up just south of the Silicon Valley. I saw the .com bubble, right? I've seen we saw the 9/11 market crash. We've all seen the 08-09 financial crisis and now this COVID thing. So I'm anticipating that it's more likely than not that I'll have a couple more of these once in a lifetime challenges.
Yeah.
But I know that even from talking with my parents and other boomers that, there is a mistrust of the financial services industry. And I think that came from back several decades ago, where it was more of a product or transactional type of engagement, where you're being sold something and then the advisor's gone and you're kind of stuck holding this investment that you don't understand, and maybe you get burned and lose some money on that. Mm-hmm. Today, now that we're more of an advice-based industry, it's really important that financial advisor has a holistic view of all of the assets so that the advice that they give you is accurate. And if we think about it, I used this analogy when we were talking, Ron, that if we had two quarterbacks playing in a football game at the same time, calling different plays, it would be pretty chaotic, and it would be unlikely that they'd get the ball down the field.
Sure.
So having one financial advisor who can coordinate all those accounts and get them to work together is our best shot at avoiding unnecessary taxes.
You remind me about a friend of mine who went to her first football game. And we asked her, what did you think about that, Don? And she said, well, it was really interesting. In the very beginning, they tossed a quarter. And then for the whole game, they kept saying, get that quarter back. I don't understand.
I warned you, Steve. I warned you.
I like that one. So just to wrap up this case study of John and Pat, after working with this advisor and getting that consolidated view of all their accounts and getting things coordinated, they were able to improve their tax efficient score and optimize it to 100, which increased their likely after-tax rate of return all the way up to 7.6%. So it's a very considerable amount of money. And over that 10-year period of time, and it's not like when you retire, all of a sudden you sell every investment you have. Those investments are going to continue. You're going to sell them at a rate as you work through retirement to generate cash to support your spending. So that money continues to operate in an efficient way well into your retirement. And so it's valuable not just to the point when you retire, but well into your retirement as you spend those assets to support your spending. In this case, that generated an additional $136,000.
And what did this client pay the advisor for the benefit?
In general, the fee to work with a fee-only financial advisor is about 1% of your assets.
Okay.
On an annual basis.
Okay.
So in this case, that advisor that did this is adding at least a third of their fee they're paying for themselves.
Right. So $15,000 for the size account, roughly. Yeah.
$15,000 a year.
That's good. Okay.
Now, in addition to that, I mentioned John and Pat had planned on filing at age 66, which they thought was their full retirement age because someone who was a little bit older than them told them that, and they just took them for their word. So we can see there that just by following a new Social Security optimization plan, there was an additional $164,000 uncovered that they could get from the Social Security Administration.
Yep.
Right. So sometimes this advice is varied, and it's really important that if you're interviewing a financial advisor that you can ask some of these questions. You don't need to understand all the nuts and bolts, but you can ask them, are you going to be able to manage my accounts to reduce unnecessary taxes? You can use terms like smart householding and ask them when you're interviewing them, are you going to be able to help me coordinate these things so that I'm avoiding unnecessary taxes and improving my likeliness at a successful retirement? Are you going to consider the role that Social Security will play? Are you going to coordinate that alongside my investment accounts? Because a lot of times, don't take my word for it, but some advisors, as I just mentioned, they're going to charge a fee on the assets that they're managing for you. Mm-hmm. So go ahead.
I was going to say, we talked about financial advisors in one of our shows, and
a lot of our shows,
a lot of our shows, and we realized that financial advisors just do not have the knowledge and the wherewithal and the tools available to them. They're not using them. So I take it this is another tool that they're definitely not using. Is it because they're not aware of it, or they're afraid of it, or what's the reason?
They can. I mean, it's available to them, but the thing is, adoption, especially with financial advisors, like with most people, Why fix what isn't broken? So if I'm unaware that these tools are available, or my business is just humming along and my clients are happy and they're not asking, well, then why would I change it?
That's right. Yeah.
I think it's important for the consumers and the investors out there to drive some of this change and demand that people are paying attention to it. Because at the end of the day, if I'm a financial advisor and you're not complaining about unnecessary taxes that are being paid because you think it's just status quo, why am I going to change anything?
You're right.
I'm going to voluntarily do extra work. So I think it's important that it's a groundswelling and that investors start to be aware of this and take some ownership of their own, legacy that they're going to leave.
Mm-hmm.
Yep. We've been preaching that the investor really needs to take more control and trust but verify. But on the other hand, they don't know what they don't know. So that's why we're asking folks like you to help us out.
Right.
That's exactly right.
Yeah.
And the last thing I was going to mention about the Social Security strategies is when you're interviewing or working with a financial advisor, believe it or not, I mean, if they're charging a fee on the assets that they're managing for you, and there's this other bucket of money that they're not necessarily going to get paid for, we've heard it before that advisors will recommend that you file your Social Security early. And it uncovers later that it's because they don't want you to spend the money that they're charging a fee on.
Yeah.
Even in this example, that it's going to improve their outcome. There's the punching bag. Exactly.
Yeah.
So there is this new attention being brought to financial advisors having a fiduciary responsibility. And
they do.
That they put the best interest of their clients before themselves. And those advisors that are taking that fiduciary responsibility are generally going to be giving the advice that's going to improve the holistic outcome of their client, regardless of if that helps.
Yeah.
Them. And I think that's extremely important.
Yeah, absolutely. Yep.
Yeah, I wish all professions would have that attitude, don't you think? Okay.
Yep, absolutely. So as we have talked about, just as a recap here, I prepared a few key takeaways, but most investors out there that have worked their way through their career end up at retirement with 6 or more accounts. And generally those accounts were set up, given advice that was isolated, and those accounts aren't coordinated. And so the sooner that we can coordinate those accounts and get them working together to reduce our unnecessary taxes, the better off we're going to be. So the industry was set up to treat each account, or sometimes even each investment, in its own little silo. And so the more that we can do, whether it's through using free account aggregation, working with our bank, or going out and interviewing financial advisors to coordinate and adopt this smart householding approach, the better off we're going to be and the more likely we're going to be to have improved outcomes throughout our retirement.
Great.
Okay, that is wonderful. Is that
That's the conclusion.
That's the conclusion. Okay.
Yeah.
All right. Well, this was fabulous. I learned an awful lot, and I also know that I can't do a do-over.
Yeah.
It's too late. It's too late for me. Yeah. Okay.
Well, Kathy, you're helping plenty of other people. So.
Yeah.
Okay. Well, Steve, thank you so much for being on the show.
Thank you.
We appreciate it. And we'll send you the links to where you can get it. Okay.
Great.
Okay. So you want to talk about the future?
Yes. Let's talk about the future. Yeah. Okay.
So before you even do that, I want to show people a book.
Okay.
Let's see. Can you see this? Fewer, Richer, Greener.
Yeah.
So one of my friends, a really smart guy, Larry Siegel, wrote this book, and it's really uplifting because we get so much bad news. It's all good news that we're in a sweet spot historically. Everybody's really much better off, and they're going to keep on getting better off. So I'm pretty sure Larry's going to be our guest on the next show, and just tell us all how lucky we are.
Okay. Yeah, that's good. By the way,
uplifting show.
Yeah, I wanted to show that we had somebody this Rick, he said, we at Today's Senior Magazine endorse and support the Baby Boomer Investing Show led by Ron Surz, and are honored that the show is a presence in our publication from Rick Bava, Today's Senior Magazine. Yay! Thank you so much. What a great endorsement.
By the way, Rick wrote a very popular book for baby boomers. I won't remember the name of it, but he's a famous author. So it's a nice endorsement.
Okay. And also we have a Patreon page, and I put that in the comments in the show here.
Great. Thanks, Kath.
But we also have this.
Right. So I'm just going to ask for your support, and we're not asking for money or anything else. Just please visit us on Patreon. If you want to be a patron, that would be wonderful. But certainly follow and like us on Facebook. Subscribe on YouTube. You won't have any trouble finding us. We're the Baby Boomer Investing Show, and we really appreciate your support. So with that, we'll say thank you for
and
listening.
we'll see you in a couple of weeks. And thank you again so much, Steve, for being on the show.
Thank you, Steve.
Okay, bye.